Good afternoon, everybody. Thanks for joining us today. We want to thank you today for spending an hour of your time with us. We've got a couple of exciting topics to discuss with you today. It's been 8 years since we've had a major tax bill passed in the US, and we're grateful today that you took some time to join us to learn more about the changes and how those changes will impact you and your family and your financial plan in the future. And then second, we've had an unusually great start to the year in the capital markets, with some dynamic movements certainly throughout the year and some really interesting for performance from areas that haven't necessarily performed well over the last couple of years. So we're really excited to get to share that good news with you as well. This is a little bit like Christmas for those of us that are financial planning and tax planning nerds. When we get a new tax bill, we're always interested to dive in it and talk with you about how it's going to impact you and your lives. So thanks again for taking time to join us today. Before we jump in, just a couple of tech learnings and tech points for you, just to make sure everybody gets the full experience today. First, we want to make sure you're viewing this today in full screen. So just a couple of tips. In the upper right-hand corner of your Zoom window, if you click on the small view icon, we just want to make sure at the bottom that full screen is selected. That'll make sure you're getting the full effect. And then second, just like we have in the past, we've muted everybody's line to make sure that we're not capturing background noise. So what we'd like you to do is ask questions today via the chat icon, and if you check at the bottom of your screen, okay, in the very bottom toolbar, you'll see a chat icon there. If you just click on that chat icon, and then there's going to be an option for you to select ACM chat. If you select that, type your question in, it'll be anonymous. The other people on the Zoom meeting won't be able to see your question, but we'd really like to make this interactive today. We've gotten a couple of great questions ahead of time, so thanks to those of you that answered our email with questions that you had. We're going to address those that have already come in, but we're hoping that we'll get some more today and have an opportunity to make this really interactive. Before we get started, we've always got a disclosure here. Just so you know, we'll be discussing performance of both the funds that we use and just the markets in general today. And we just want to make sure everybody remembers that past performance is no guarantee of future results. And especially with the strong start that we've had to this year, again, we want to make sure you know that this is not indicative or a guarantee of future results. So, a pretty short agenda today, a couple of really big topics. We're going to discuss the big, beautiful bill. We're going to start off with that. And again, how it's going to impact you and your family. We're going to hear from Trevor, Lavia, and Mike Keller on the big, beautiful bill. And then we'll turn the page, and Katie and I will tackle performance, both short-term performance this year as well as longer-term performance. And then finally, Katie's going to wrap us up with a couple of really exciting firm updates that we wanted to share with you.
All right, I'm here today with two members of our advisory team and financial planning committee, Trevor Hotmer and Mike Keller. We have our espressos in hand and are energized to talk about the One Big Beautiful Bill Act. As a quick side note, I think the most shocking outcome is the fact that Congress was actually capable of meeting a deadline and gave us time to digest this information and plan accordingly. So, for some historical context, I want to give you a quick review of the Tax Cuts and Jobs Act that was passed in late 2017 because it's related to the One Big Beautiful Bill. In simple terms, the Tax Cut and Jobs Act's goal was to stimulate economic growth by lowering taxes through cutting corporate tax rates and reducing the marginal income tax rates for individuals. It also sought to simplify taxes by doubling the standard deduction, which led to fewer people needing to itemize. It also encouraged U.S. business investment through incentives like bonus depreciation and the QBI deduction for pass-through businesses. Now enter the One Big Beautiful Bill Act, which was signed into law on July 4th of this year. While not officially marketed as such, it is basically Tax Cuts and Jobs Act 2.0. And the new legislation permanently, and by permanent, I mean in place until another administration changes these provisions. It extends most of the Tax Cuts and Jobs Act. It modifies other parts and adds new provisions. Some of these provisions are effective in 2025 and others start in 2026. So today we want to walk through key highlights of the legislation and call out the most important areas from a financial planning perspective. Now, these changes don't necessarily fit neatly into a single tax or financial planning category, so it's really important to view these provisions collectively. Understanding how the extended, revised, and new provisions interact, because they can really create meaningful planning opportunities. So, Mike, let's start with what's staying the same for investors.
Thank you, Olivia. Yeah, first, I want to say that the marginal tax rates are remaining consistent with the previous Tax Cut and Jobs Act with the same seven brackets that you've come accustomed to. One slight change is there's now more room in the 10 and 12% tax brackets, and you see as well listed there with the extra cost of living increases in 26. And with our progressive tax system, this is something that actually benefits all taxpayers. And additionally, capital gains tax rates are going to remain the same. So this stability allows us to plan your income and investments with predictable tax outcomes, and everyone gets the benefit of the Tax Cut and Jobs Act brackets. Even those in higher brackets get the benefit of the expanded 10 and 12% brackets. And in 26, your effective tax rate will reduce because more dollars are going to be taxed in that 10 and 12% bracket.
So that seems pretty straightforward and nice to see a modest increase in the 10 and 12% brackets starting next year. Now let's talk about what changed and when it changes. The SALT cap was a very specific contested topic, along with a few other deductions as the bill migrated through Congress. So what is SALT and what changed and when does this go into effect?
Yeah, first we'll look at here the updates that are effective of 2025 onward, and some of these changes are going to be permanent, while others that are a little bit more expensive in nature are going to have sunset dates that you'll see listed on the slide. So first we'll look at the changes happening this year. The standard deduction has increased. You see there from to 31,500 for couples married filing jointly, and then 15,750 for single filers with no sunset date. The senior 65 plus get an extra $6,000 per person deduction, but this is subject to income thresholds, and that phases out at $150,000 for joint filers and 75,000 for single filers in 2028. That's good through 2028. Now, the SALT, which you mentioned, Livia, which stands for state and local tax. So, for example, think property taxes and state income taxes. That deduction cap is now 40,000, and that will be through 2029, and that phases out at an income of $500,000. So this could impact high tax state residents as well as business owners. Next, we'll look at some of the changes starting in 2026. Specifically, the estate and gift tax exemption raises to 15 million, and then for joint filers to 30 million. And that will again in 2026, and that has been made permanent with no phase out. The child tax credit is going to increase to $2,200 in 2026. And this is the first time this particular tax credit is indexed for inflation. And additionally, charitable giving now has a 0.5% floor with a 35% cap for joint filers. These changes can optimize your deductions and credits, but we would need to strategize around phase outs and sunsets. So what does this mean and what is this? How does this impact you? Higher standard deductions lower your taxable income, especially if you aren't itemizing. Seniors benefit from extra deductions, but plan for the 2028 phase out. If you live in a high tax state, the SALT cap and phase out may reduce your deductions, so consider tax efficient investments. Larger estate exemptions offer estate planning opportunities, and the child tax credit can ease family expenses. And additionally, the charitable giving adjustments will help us refine your donation strategy. So for those looking at future donations, especially with donor advised fund contributions, if you're thinking about a DAF or thinking about using a DAF this year, you'll get more bang for your buck. And if you're thinking about charitable giving and you are in the 37% tax bracket, we would recommend a conversation around this topic.
Great. So good news is we keep the lower brackets. It's also great to see there are some added benefits for those using the standard deduction and those with some charitable goals. It is interesting, a little departure from Tax Cuts and Jobs Act of 2017 is now we're going a little different direction in terms of these deductions being increased and now encouraging more people perhaps to consider itemizing in the next few years. So, Trevor, another hotly debated topic was whether or not to tax Social Security income. What financial planning considerations should people be thinking about, and what was the outcome on Social Security?
Yeah, great question. When thinking about different financial planning considerations, what we did here is we separated these topics into three different categories based on the phase of life you're currently in. For retirees, Mike will answer your question on Social Security and talk through Roth conversion opportunities. For those working individuals and families, I'll talk about the increased deduction, 529 planning, and an update on HSAs. And lastly, Mike will mention for business owners and talk to increased deductions and reduced taxable income. One thing you'll notice is we have charitable giving listed under retirees and working individuals. As Mike mentioned earlier, this affects both groups due to the 0.5% of AGI floor and the 35% cap on itemized deductions. That being said, this does not change anything regarding qualified charitable distributions or QCDs for those over age 70 and a half, making qualified donations out of their IRA. One thing I did want to point out is you may be thinking about how these considerations may impact your financial plan. Our financial planning software will be doing a universal update, which will go into effect this Saturday morning or July 26th. For Aspen Capital Management clients, we want to reassure you that this bill likely won't trigger any changes to your overall strategy, and you should actually see an increase in your plan's probability of success due to these lower tax rates. If you're not a client of Aspen Capital Management, we hope this gives you a helpful framework with a few items to consider going forward.
Thanks, Trevor. That's a great note also about the financial planning software that we use. We've actually had a few annual reviews with clients so far in July, and definitely noticed the immediate positive impact of lower marginal income tax rates going forward. So, Mike, what does this look like for clients who are retired or just beginning their retirement?
Well, especially regarding Social Security, I think the key point here is that your Social Security income is going to remain taxable just as it was before. So what does this mean? It means, again, your claiming strategy should stay the same as it was before the legislation, and there's no major adjustments that are going to be needed based on this change alone. And additionally, the bonus senior deduction is a new benefit and is the $6,000 per person age 65 more or $12,000 per couple, even if you itemize. However, there is a phase out if your adjusted gross income exceeds $75,000 for single filers and $150,000 for couples. So what does this mean? This is going to present us with expanded opportunities for Roth conversions and lower tax brackets, but we still have the point of it does not make sense to take permanent reduction in your Social Security benefits.
That's a great comment about staying consistent when it comes to someone's Social Security claiming strategy. We've had this question a lot in the last few weeks, as you could expect, and our clients have really benefited from and enjoyed using their plan as a decision tool rather than reacting to what's in this legislation. Trevor, does the new legislation change planning for people in their working years and or those with young families?
Yeah, there's definitely a few planning opportunities for working individuals and families. Let's first start with the increase to SALT or state and local taxes, which, as you mentioned earlier, is actually one of the biggest questions heading into the negotiations on this bill. In the past, this has been capped at $10,000, but it's now increased to $40,000 starting immediately in 2025. This will increase each year by 1% until 2030, which is when it will revert back to the cap of $10,000. Why is this important? For 2025 to 2029, this could lead to higher tax savings should you choose to itemize your deductions. I do want to point out here that if your income is at or over 500,000, you may actually see this deduction phase back down to $10,000, and we recommend reaching out to us and your CPA to talk through additional deductions or strategies. Another item here is 529 plans. You can now use up to $20,000 per year from a 529 for K through 12 private school expenses. Not only is this an increase from what used to be $10,000, it also comes with an expanded list of eligible expenses such as curriculum materials, textbooks, tutoring costs, and even professional credentials, to name a few. It's important to point out that the $20,000 limit doesn't begin until 2026, but the expanded list of eligible expenses does start in 2025. So make sure to go look for those receipts if you have any of these expenses this year. Lastly, there were a few small changes to health savings accounts or HSAs. And remember, to save to an HSA, you have to be on a high deductible health plan. And what this bill did is expand the definition of a high deductible health plan to now include both bronze and catastrophic plans.
Next, moving into how this affects business owners. And at a high level, the good news is this means more deductions for business owners. And specifically, starting with LLC or S Corp owners, there's good news that there's no changes to the existing structure. So with this, you can continue to effectively pay your SALT taxes through your business, maintaining the same tax strategies as before, and there's going to be more deductions available. For your QBI deduction or qualified business income, that has been permanently extended with a phase-out range of $150,000 for married filing jointly and $75,000 for all others. And you're guaranteed a minimum of $400 QBI deduction if you have at least $1,000 of business income. So again, key here is no expiration, and this deduction is going to be a long-term benefit. And the increased phase-out range gives you more flexibility before the deduction reduces. And then with Section 179, now offers a maximum eligible deduction of $2.5 million with a phase-out beginning at $4 million of property and 100% bonus depreciation that does not expire. So what does this mean? No expiration, and it further reduces your taxable income for businesses, and it improves your tax savings in the first year and have expanded eligible expenses.
So after walking through this, it sure seems like the development of this bill really provided more political theater than any meaningful changes. And after going through the different seasons of life for our clients and their planning considerations, there really doesn't seem to be a significant level of change here.
You're exactly right, Livia. A lot of noise here, but not a lot of meaningful changes. There are a few different perks in this bill that you or even your kids could find useful, though. This bill includes a new deduction for car loan interest, but this comes with some caveats. To be eligible, the loan must have started after December 31st, 2024, and the car must be assembled in the US. Next is the new Trump accounts. While the program doesn't start until July 2026, children born between 2025 and 2029 are now eligible for this account. Children can receive up to $1,000 from the US government, and there are annual contribution limits for parents. Essentially, this is very similar to a traditional IRA that allows children to get a kickstart on retirement savings. Lastly is a change to tax on tips and overtime. This bill creates new deductions for those with qualified tip income and overtime income. Olivia, maybe you can take a minute to summarize a few of your biggest takeaways from this bill.
Yeah, I'd like to say first and foremost, I understand there were a lot of opinions about this legislation as it was going through Congress, and there continues to be a lot of opinions after the fact. So I just want to thank both of you for sharing your expertise and offering a really objective view of the details and planning decisions here. So, I'd say my takeaways, I think, from everything we've discussed is that good news, we'll have lower marginal tax rates for the foreseeable future. As always, do leverage your professional team, which would be your financial advisor, your CPA for income planning, and things like Roth conversion strategies. Make sure that you're working with your estate planning attorney for any sort of planning needs. It's really important to have clarity about the income thresholds and shorter term expiration of certain deductions. And then I would say the most important point is your goals really need to drive your plan, and really helps to separate what you're concerned about politically from what you decide to do with your portfolio and retirement income. It's great to be informed, which is exactly what we want for our clients when understanding the specifics of this bill. Just don't let it drastically change decisions that will impact your financial plan. So I see we've got some questions coming through. So Mike, I'll turn it over to you.
Yeah, Livia, a couple of questions, and maybe Livia, you can take this first one. And it was a question around the term phase out. I think we use the term phase out in a number of areas there. The question was simply exactly what is a phase out and how might that work?
Yeah, that's a great question. So a phase out is imposed on an income threshold. So a deduction or perhaps a credit is fully utilized up until a specific point. And then after that income threshold is reached, you start to get less and less of that deduction by way of percentage. And then as you go through the phase out range, you essentially lose that deduction in
Excellent.
terms of income.
Excellent. Thank you. Trevor, one from your section, a question came through on when you were discussing 529 plans. You mentioned that they could now be used for some professional credentials. What exactly would those be? And maybe could you give us an example of one?
Yeah, any sort of continued education, and really the best example and what we find most useful is what we have is the CFP. Livia Thomas, a member of our team, is a CFP. I am studying for the CFP currently, and many other advisors on our team will also study for the CFP. And then we also have Nate Berman, who is a CFA. If you're not familiar with either of those two, one you may be is a CPA, or for accountants, chartered public accountant.
Great. And then there was another question on 529 plans. Could those be used for like trade schools, or can they only be used for like 4-year college degree programs?
No, you're exactly right. Trade schools are also included in that as well.
Great.
All right, let's shift from what you owe the IRS to what the market can do for you in terms of returns.
Hey, great. Thanks, Livia. Hi, everyone. This is Katie. I'm thrilled to be here with you today. I can't see you, but I know you're there. So thanks for joining us. Today, I get to talk about the market with Mike, which is, the market has really given us plenty to talk about. It's been an eventful year in markets, to say the least. We've experienced some dramatic swings, which I'm sure you all have been watching, or maybe you haven't, even better, particularly in the US markets. Back in March, for example, the market dropped nearly 15% in just 3 trading days. But then in a remarkable turnaround, it surged 10% in a single day, making it the 8th best trading day in US history. Fast forward today to today, and the S&P 500 is now up 27.5% from its April low. So in this session, we're going to zoom out a bit and look at year-to-date performance in the context of historical trends. All right, so let's get practicing with that chat box. Let's remind everyone how to do that. Again, we want you to utilize that to ask questions. But to get you more acquainted with it, at the bottom of your screen, I want you to put in the asset class on your screen right now that you think has performed best year to date. All right, so just somebody chat me. Anybody out there, chat me which asset class you think has performed the best. Mike, is anybody chatting?
It looks like we had our first one come in, but it is not any of the asset classes on the screen. So somebody wanted to know, how did crypto do?
We're not talking about crypto today. You're going to have to look that one up on your own. It's been a wild ride.
Oh, we do have somebody here with the right answer,
Oh,
Katie.
okay, who is, well, just tell me what they've said.
Oh, no, we've got somebody. Yep, we do. We have somebody with, I don't know if it's the right answer, but we have a couple that have said international equity.
All right, good. That tells me that you just had your annual review and somebody just told you that that international equity was the best performer. Thank you for those very tax savvy clients who listened and using your chat box. And you're right, international equity is our best performing asset class. It's not the only story here. So really quick, again, really nice recoveries from early April when we saw the lows in US markets. Again, this is just through June 30th. So we've seen some really nice performance this month as well. We've had positive returns in each asset class, which is just really kind of incredible. But when we think about this, the real story this year isn't just about the US recovery, it's the remarkable strength in international and emerging markets. While US stocks have managed to claw their way back, international markets have dramatically outperformed, delivering more than 4 times the return of US equities so far in 2025. But has that always been the case? Let's step back and look at the last decade for some better or more perspective. Over the previous 10 years, we saw the exact opposite story. US stocks significantly outperformed global markets. Now, you'll remember a big part of that outperformance was driven by a small group of mega cap tech giants, often referred to as the Magnificent Seven. These are the household names you all know well: NVIDIA, Apple, Amazon, Meta, Microsoft, Google, Tesla. They dominated headlines and markets thanks to a powerful combination of superior earnings growth and price to earnings multiple expansion. Now, I know that's a lot of words. So, in other words, not only were they making more money than their global peers, but investors were also willing to pay increasingly higher premiums for every dollar of earnings. That's the 1-2 punch that fueled the decade of explosive returns.
Yeah, and Katie, when we get a little bit further, we're gonna recognize that that same 1-2 punch has happened in previous decades. But so we've had this decade plus period that you just talked about where the US market was really dominant around the world. But what if we go a little bit further back in time?
Yeah, that's why our jobs are so interesting, Mike. If we go back further in time to the decade from 2000 to 2009, we get yet another story. During that time, US stocks were the only major asset class with a negative annualized return. That period is often referred to not so affectionately as the lost decade, and it was a tough stretch that shook the confidence of many US investors.
Yeah, Katie, it's such a great way to highlight this where investors, most everybody on this call today was likely an investor in some way, shape, and form back in that lost decade. But it's amazing with recency bias how quickly we forget, right?
Mhm.
How quickly we forget that it wasn't that long ago that the US was the single worst performing market anywhere in the world. And during that decade, emerging market equities were up 250% during the decade. Now, what's interesting about that negative period or that roughly flat period for US equities is, as you mentioned before, it's a combination of both earnings and valuation. And that was actually a decade where many companies continued to grow their revenues and grow their profits. Investors just decided to pay less for a dollar of those earnings.
Right.
And that valuation contraction really drove a very flat performance for an entire decade, even though companies were continuing to grow and prosper. So we've actually seen this story before. These last 2 decades that you've highlighted here are really not the only time that this has happened. If we go back to that window of time right before the lost decade, you'll remember, Katie, that window from 1995 to 1999, where the S&P 500 over that 5-year period had an average annual return of over 28% a year. The US just absolutely trounced the rest of the world in performance in that 5-year window. So, just like today's story, it was driven by a combination of tech company profit growth and expanding valuations where investors were willing to pay more and more for a dollar of earnings. And in fact, that's actually not the only period that we're looking at here, this lost decade of 2000 to 2009. That's not the only period of poor performance in US stocks. Many of the people on this call were alive at some point in that window from 1965 to 1981. That was a 17-year period where the S&P 500 underperformed treasury bills for a 17-year window. So it's not terribly unusual to see this happen as long as you're willing to go back and take a long-term perspective.
I certainly don't remember that time window, Mike, but I know you
You're going to
did.
trust me?
Yeah,
You're
yeah.
going to trust me on that?
I've read
Okay.
about it.
Yeah,
Read about it.
thank you. I appreciate the trust.
Well, Mike, okay, so some investors would say, and then some clients, have said to me, well, wait a second, I see a pattern here. International outperformance, then US outperformance. Are we about ready to see that again? I guess the question is, should we own more international stocks right now?
Yeah, it's a great question. It's a great question. And in fact, it was a question that we answered in 2008, 2009 as well, right? But I would break that down into maybe two components. The first component is that investors have to remember that historically there has been no strong correlation historically between market performance or valuations and future short-term market returns. Okay, there is no historical correlation between those two. Now, we can't use either of these metrics to time the market. Expensive markets that have performed well can continue to remain expensive and perform well for many years. So the key for investors is to remain broadly diversified all the time. And an example of that is take us back to January, right? We were seeing all the market forecasts at the end of January. And I don't remember a single market analyst pounding the table for international or emerging market stocks, right? Everybody expected this US market dominance to continue into 2025, right? Nobody rang a bell in January and said, hey, a great rotation is beginning. And then my second answer to that, Katie, would be, look, at Aspen Capital Management, our clients have always been diversified and owned a really healthy dose of both international and emerging market equities. So no, if you ask me, do our clients need to own more international stocks? Not at all. We've had great exposure really since the firm started 23 years ago. Now that's probably different for many of our clients, friends, and family members, because we consistently see that most US investors, their portfolios are primarily made up of just exclusively US companies.
Yeah.
So for your average investor, yeah, they probably do need to add some exposure.
Yeah. Okay, good. So to summarize kind of what we've learned here so far is A, global diversification is key. B, market valuations are a poor tool for timing the market. Like we say all the time, markets can stay expensive for a long time, but it's not likely they'll stay expensive forever. And you have to capture the returns in windows when markets are expensive, right?
Yeah, that's right, Katie. So one thing to remember, right, is that the US market does not have to tank for it to be cheaper on a valuation basis.
Right.
I just gave that example of 2000 to 2009. Companies can grow profits while investors simply choose to pay less for a dollar of those earnings.
Yeah. And then I like what you said about ACM clients. ACM clients have had above average international diversification and exposure for 20 plus years if you've been with us for that long. And that's really on average 2 times more than what other US investors have. So we don't need to buy more international stock. You already have it. Now we just get to take that win. So bottom line is be globally diversified at all times, own all the great companies of the world and stick to your plan.
Yeah, and Katie, this is going back to the question. So we had a question here that I think that this idea of global markets ties really well into a question that just came through about concerns over the rising U.S. deficit. Somebody sent this to us. We sent everybody an email asking for questions. We had this one come through yesterday, so we prepared some information on this idea of the concern over rising U.S. deficits. And I would start by just saying, look, as citizens, I think most of us are very worried about this trend, right? What we're graphing for you here is the US federal deficit, okay, as a percentage of US GDP. GDP is gross domestic product, or basically our economy or our economic output. And I think everyone's probably reasonably well aware the last couple of years that our debt as a percentage of our economic output or our GDP is approaching levels that we've only seen one time historically. And that's back in the 1940s when the US was investing heavily to win World War II. And we were spending to work out of the Second World War. Now, when we look at this period, again, I think that everyone is concerned about this, right? But yet, I think it's yet another example of how we need to divorce our emotions from our portfolio management decisions. And let me give you an example, right? The data that we're looking at here, well, you can see that this data, it's public data. Everybody knows it. You hear people talking about it every day on news channels. You read about it all the time online or in the paper, right? So everybody knows about it. It's in the headlines and everybody's talking about it, which means it's in the price, right? This information is baked into prices today, both in the global equity markets and in the global fixed income markets. So it's in the expectations for what investors believe will happen going forward. Now, the important thing I would note here, and quite frankly, just for me personally, it's an area that concerns me because we don't have an answer for this, right? There is no known threshold for which a country's debt to GDP ratio, once it exceeds a certain threshold, that their economy will have issues or that their financial markets will have issues. And just some examples, Katie, the Japanese economy, Japan has been above 200% debt to GDP ratio for some time now. And their markets have performed exceptionally well over the last few years. Belgium is a country that's been above 100% debt to GDP for 34 of the last 49 years. And in those 34 years where their debt exceeded 100% of their GDP, their capital markets average annualized return was 15% a year.
Wow.
Yeah, and today there are currently 8 global developed market countries that have debt to GDP ratios similar to ours, above 100% of GDP. So it's relevant information, no question, but it's baked into both stock and bond prices. And the part that I think we all struggle with is that historically, nobody has yet to hit a magic threshold. And so we're really kind of dealing with the unknown here. But the one thing we do know is that historically, this ratio has not been a predictive power in predicting what will happen in either equity or fixed income markets.
Yeah, wow, that is really interesting. So, 2 top takeaways, Mike, from kind of where we're at today. Number 1, separate your feelings as a citizen of the US and the decisions you make as an investor. I think we like to say, don't vote with your dollar, vote with your voice, but really it's just that division of what's happening politically, maybe versus what you're going to do or what action you might take as an investor. And then second, this is just another great reason to diversify your portfolio. You can't predict the future, and you don't have to get everything right if you just own all of the great companies of the world.
Hey, Katie,
Yeah.
you're going to love this.
Oh, good.
We've got a question
Okay.
that just came in from a client of yours. And for the record, for everybody, just to give you some context, This question came in from a client of ours who is spending months traveling Europe
Yeah.
in a camper, camping in Europe. And Frank sent us a question, and he asked us this question that's going to lead right into, I think, the question that we got yesterday about the weakening US dollar. And Frank wanted to know if this really strong international equity performance this year is due to stock price performance fundamentals or the weakening US dollar.
Yeah.
Right? Which is a great question. Frank, thanks for sending that in. By the way, we hope you and Lisa are having a wonderful time in Europe. But in the meantime, great question. And the direct answer to that, Frank, is it's actually both. There have been great fundamentals, and even in local currency, international and emerging market equity performance has far surpassed that of U.S. investors, but the performance has far surpassed that of U.S. equities. However, you're exactly right. The U.S. investors' investments in international markets has been boosted a bit in US dollar terms because of the weakening US dollar.
Yeah.
Okay. So let's actually transition that into this question that came in yesterday around the weakening US dollar. And the first thing I want to start with here, Katie, is let's start with time horizon.
Okay.
Right? We've seen it in a lot of headlines. You got politicians talking about it. You see it in headlines everywhere that the US dollar has weakened. I chose the US dollar versus euro here, not knowing that Frank was going to be kind enough to tee this question up for us. But if you just look at like a 3-year window here, in a really narrow window, you see that in the last 3 years, the dollar has weakened pretty substantially against the euro, right? So this downward trend that we see the last 3 years is really what's caught everybody's attention, both in politics as well as in the media. We would say, hey, you've got to take a much longer than a 3-year perspective. So perspective really matters here, right? If we go back and we look at the last 20-year period, you'll see that it depends on your time frame. If you're looking at it over the last 10, 15, 20 years, you might draw a very different conclusion, right? That the dollar hasn't weakened dramatically over the long period of time, right? So I think perspective really matters here in this discussion. And let's discuss the perception the media creates around this narrative that the term or the word weak is bad and strong is good, right? Probably one of the biggest misunderstood concepts, economic concepts, is that a strong US dollar is great for the economy and for investors. And in many cases, that really isn't true. Okay. So if we just look at the S&P 500, Katie, so 500 large US companies, about 40% of their revenues come from outside the US. Okay. So foreign trade is incredibly important to large US companies. When the US dollar is at all-time highs, like it was 3 years ago, right? This makes US exports very expensive. And large US companies that do a lot of business outside the US generate less revenue and less profit on their foreign sales. If we have a much more moderately priced US dollar, I'm not talking about a really weak one by historic standards, but if we've got a more moderately priced US dollar, it makes US exports cheaper and much more competitively priced on the global market.
Right.
Okay. Multinationals or big US companies, they have higher revenue and higher profits in US dollars from those foreign sales. And for US investors, foreign stocks and bonds become more valuable in US dollars. And this is exactly the question Frank was asking.
Right.
Hey, as the US dollar weakens, it can make that stock price performance in international markets even better for US investors than it was for local currency investors in those markets. And we have certainly seen some of that this year, but that's definitely not the whole story. Now, I will say that a more moderately priced US dollar is a headwind for US small cap stocks, but it is a tailwind for international and US large cap stocks.
Great. So I guess to summarize for Frank and everyone else, two major points to remember here. First of all, don't get too nervous when you're hearing the word weak in context to the dollar, or too confident when the dollar is strengthening. Neither extreme for the dollar is actually good. It's just, I guess, moderate is the most optimal, right?
Yeah, certainly if you could pick it and choose it, I think moderate would be a nice balance of having our companies really competitive globally.
Yeah.
No question about it. So again, I think just getting people to divorce that language of weak is bad and strong is good and understand the economic implications of both of those is important.
Yeah. And then second, most importantly, for a global investor, we really don't have to worry. Parts of our portfolio will benefit while other experience headwinds. This kind of goes back to what we always say. Trying to time the currency markets is a fool's game, just like it is trying to time equity markets. Owning a globally diversified portfolio eliminates your need to try to time currency fluctuations, just like it eliminates your need to try to time asset classes.
Such a great example, Katie, right? Of by not trying to time those, right? Whether the dollar strengthens or weakens, there is some place in our portfolio that's going to benefit from that.
Right.
And
yeah.
we don't have to try to time it or pick it correctly.
Yeah, that's great. Okay, well, that wraps up kind of what we wanted to talk about today. Are there any other questions or anything more that you want to say, Mike?
Yeah, there were a couple of questions that came in for our friends on the financial planning side. Livia, do you want to tackle these questions that came in?
Yeah, absolutely. And just for a little bit of a framework for everyone on the call, right? The tax legislation was not something that was an overhaul. It was something that was deciding to either extend or expire what we had. And so that's important for this first question because an expiration of what we had, even though there are trade-offs like we talk about in financial planning all the time, right? Extending this tax code and adding the deductions is quite expensive for our country, but obviously letting it expire would have been very expensive for citizens. So I think this question that came in, Mike, would be great for you, which is, in light of this, what is really consequential to me as an investor?
I'd say the highlight here would be this lifetime estate exemption staying high. So that's big news for our clients because this could have been a significant change for many that would have warranted big changes overall for our clients in estate planning, financial planning, in a lot of different areas.
So it sounds like had this expired, it would have created a pretty expensive tax bill for our clients who would have obviously exceeded that lifetime exemption.
Yeah, that's correct. I think a lot of people would have ended up exceeding that exemption and either being expensive for you now or for your heirs in the future.
So I mentioned some changes to the rules about donations. And the question that came in is, as a client, should I wait until 2026 to do any of my charitable giving? Trevor, can you speak to that?
Yeah, that's a great question, and the answer is really it depends. And what I mean by that is if you're itemizing and planning on taking larger or making larger donations, I'd consider bunching those up in 2025 because there's no 35% cap this year and no floor of 0.5% of AGI. Now, on the flip side of that, if you're planning on making smaller donations and using the standard deduction, you may actually want to wait to do that until 2026, as you'll get the new charitable giving deduction that Mike mentioned earlier, which is $2,000 for those married filing jointly, or $1,000 for those single filers.
Thanks, Trevor. That sounds like a great question for our clients to consider with their CPAs, as that would be tax advice, but also working with us on that donation strategy and ideas on how to do that.
Great. Hey, one question just came in. Wanted to confirm. The question was, does the $19,000 limit still carry forward into the big beautiful bill as far as our ability to gift $19,000 to anyone. And yes, it does. So that was unchanged. It's still $19,000. So 19,000 per person or 38,000 for a couple.
All right, thank you for all the questions. We have one more kind of session to get through. It's not going to take very long, and thank you for staying with us this long through our webinar. I just wanted to give you a firm update. I have a couple of fun things to share with you today. I think many of you would believe that if I told you that we have an internal dedication to excellence here, and we're pleased to announce that the industry is noticing. This year alone, we've been recognized by 2 different publications as being a top advisor in the industry. In January, we were ranked one of Worth Magazine's top RIA firms. This is our second time on the list, and we are absolutely thrilled. I don't think it's not too bad, Mike, for a firm that started in a closet about 25 years ago, right?
Yeah, that's right.
Yeah. Worth Magazine uses a rigorous selection process to identify the best registered investment advisors, including AUM, client demographics, and unbiased advice. So we were honored to be listed as one of those firms. And then in July, we were recognized in the Financial Advisor magazine as a top RIA. So there, just to kind of build some context around this, there's around 15,000 RIAs or registered investment advisors in the country. And we were among the top 1 to 2% of those. So FA Magazine created a list based on 2024 assets under management. And the publication verifies AUM or assets under management by reviewing each firm's ADV, ACM. So we didn't participate in either one of these or pay to participate. This information was all public information and then ranked accordingly. So a big thank you to every member of our team for bringing their A game every day. It takes a village, that's for sure. And a huge thank you to all of you and all of our clients for partnering with our firm and entrusting us with your financial well-being. And secondly, I want to announce, you've probably seen it, but we have a new partner in the house, Lavia. So excited to have Lavia to join us as a partner at ACM. Lavia works with a large number of our clients and has been an excellent addition to our team for over the last 4-ish years. She's detailed, she's thoughtful, and she's highly curious. She earned her CFP while working full-time at Aspen and being a mother of 2 beautiful girls and a stepmom to 2 more kids and the wife to an equally busy husband. And through all of that, she somehow still finds time to meal prep. So very, very impressive, Livia. She's incredible. If you don't know Livia, get to know her. If you do know Livia, send her a message and welcome her as a new partner to the firm. We're certainly lucky to have her. Okay, with that, we finished 5 minutes early. Do we have any additional questions?
Katie, I don't see any additional questions. Just a reminder to folks, though, that we are recording this, and we will we'll post a recorded version of it to our website, as well as notify you via email if you've got any friends, family members, coworkers that you think would benefit from this information. You're welcome to forward that on to them. We do this so that people can learn and get value from it. So the more the merrier from our perspective. If you do have any other questions as well that maybe you think about in the coming days, please feel free to reach out to your advisor and ask them. That's what we're here for. We realize that sometimes great questions come with time. So please use this as a resource and reach out to us if you have any other questions. Other than that, have a great summer and thanks again for joining us today.